Are your farm property taxes too high for your income? Imagine working hard on your farm, but your property taxes keep eating into your profits. It's a common concern for landowners and investors alike. Today, we're going to look at what influences land value and how that affects your taxes. Understanding this can help you decide if your taxes are fair or if they're squeezing your farm's income too much. First, let's talk about how farmland is valued for tax purposes. Most states don't look at what the land could sell for if developed. Instead, they assess farmland based on its current use for farming. This method is called use value assessment. It keeps taxes lower by focusing on the land's ability to produce crops or support livestock, not its potential for building houses or shopping centers. The exact way states do this varies. Some use soil quality, crop yields, or rental income data. Others use formulas that consider commodity prices and interest rates. This approach makes farmland taxes more stable and predictable compared to properties valued for development. Now, how do these assessed values turn into actual taxes? The calculation involves three parts. First, the assessed value of your land. Second, the assessment rate, which is a percentage of that value. And third, the local tax rate, often called the millage rate. For example, if your land is assessed at $100,000 and the assessment rate is 15%, then $15,000 is taxable. If your local tax rate is 1%, your annual property tax would be $150. Keep in mind, local governments can raise tax rates to pay for schools, roads, or other services, which can increase your bill even if land values stay the same. So, how do you know if your property taxes are too high for your farm's income? It's simple to compare. Calculate your property tax as a percentage of your net farm income. If taxes are 5% or less of what you earn, they're probably manageable. But if taxes reach 10% or more, they might be taking a big chunk of your profits, especially in years when prices are low or yields are poor. For farmland investors, high taxes relative to rental income or crop earnings can make the land less attractive as an investment. What steps can you take? First, review your property assessment each year. Look for errors in acreage, soil type, or land classification. Mistakes can lead to higher assessments and taxes. Next, understand your state's rules for use value assessment and any deadlines for applying or renewing your status. Staying informed helps you maintain your tax advantages. Also, keep an eye on local tax rate changes by attending government meetings or reviewing budgets. If your taxes seem unfair or too high, you can often appeal your assessment. Many jurisdictions have processes to challenge and reduce your taxable value. For those investing in farmland, it's wise to include property taxes in your cash flow calculations. High taxes can eat into your returns, especially if commodity prices are volatile. In regions where farmland near cities faces development pressure, assessments can rise faster than farm income. This is called tax creep and can make farming less profitable. Some states with strong use value laws offer more predictable tax environments, which is good for long-term investments. In the end, farm property taxes are a key part of your overall farm economics. While use value assessment helps keep taxes fair, they can still be burdensome if your farm's income drops or local tax rates climb. Regularly checking your assessment, understanding local policies, and staying engaged with local officials can help you manage this expense. If your property taxes are consistently higher than your farm's income, it might be time to review your operation or consider other investment options. Being proactive can help protect your farm's profitability and your investment's future.